Yields down, stocks up. Live from New York City this morning for our audience worldwide. Good morning, good morning. Equities up big time, up 1.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, peak everything all over again.
All the conditions are there for a peak.
Peak yields.
The peak in bond yield.
Peak Fed hawkishness.
At some stage, there will be a peak.
The peak.
Can I use that word peak again?
You put everything together.
The fact that we have had 10-year Treasury yields break 4%.
Forward inflation expectations have dropped.
Inflation has peaked in the U.S. Growth is weaker.
There's a lot that is priced in at the very front end.
The bar is really high for the Fed.
We're certainly still seeing, some bond market revolt.
The markets are misreading the Fed and have misread the Fed all along.
That long bond is struggling to rally more.
The biggest bond market in the world should not have such weird kinks in the curve.
It's really hard because the U.S. data is strong.
It just feels like we still have a few more weeks of more shoes to drop.
We really need to see the data crack.
Joining us now to discuss is Exonic's Peter Cecchini, Cameron Dawson of New Edge Wealth. Cameron, straight to you. Peak everything. How many times have we done this and been wrong through 2022?
Yeah, we just did that back in June where we saw a near-term peak in yields. We saw a near-term peak in the dollar that led to a big rally in stocks and also the pricing in of rate cuts in 2023. And then what ended up happening is that as the yields and the dollar got back to their trend lines, what we saw is that they started rising again. And I think that is the risk here as we think about how long this rally in markets could continue from a stock basis, is that we will likely see yields go back to their trend after we had that kind of big blow off rally, but we don't see any signs of a trend break yet. The 10-year can go as low as 3.2% and still be in an uptrend.
The move we've seen in the last week is pretty clear. The 10-year yield is 4% last week, has gone down to 360. A 2-year yield at just north of 4%. It was 435 last Monday. Pete, I get it. Yields are lower. We've seen this movie a few times this year. Now, Pete, the question I'd ask you is, what did we get wrong through the few times we've seen this play out last time? And how do we know if we're right this time?
Well, I think there are a couple of things to consider here. The first is to the question, have yields peaked? We might actually ask, does that really matter at this point? Our thesis here at Exonic has been that we were close to peak yields, certainly at 4% on the 10-year, that we'd see a retreat from there, and that the next phase of the pressure on risk assets would come from earnings. And the damage, if you will, maybe that's the wrong word, but the damage to the real economy from hikes is just starting to occur. And the same, I think, therefore, can be said about risk assets, especially when you look at the riskiest of those, which are, for example, equities and perhaps speculative grade loans, which are two areas we're remain particularly concerned about. So where have we been wrong in the past? I don't necessarily think that's all that relevant to the, maybe everybody's calling for a peak. I'm not sure that's really the relevant question at this point. The point is, even if we have peaked, what's next? And I think the next leg down, the catalyst will be something very different from the rate move. And I think that's really important, that transition.
Pete, you're welcome to answer your own questions whenever you like. Marko Klanovic at JP Morgan had this to say: "We're growing increasingly worried about central banks making a policy error. While we remain above consensus positive, these developments are likely to introduce delays in the economic and market recovery, putting our 22 price targets at risk." Cameron Dawson, I think if you asked a lot of people for evidence of capitulation and they were snarky enough, they'd say, find me the biggest bull on Wall Street and show me that individual starting to crack. That's what we're starting to see with JP Morgan. What does that mean to you, if anything at all?
Well, I think that there is just a growing appreciation of what the real earnings risk is. Of course, from a contrarian perspective, it's good to see bulls crack and you start to see them throw in the towel. I think from capitulation, we still haven't seen that retail investor crack. We still have about 65% allocation to equities. It usually goes down to 45% during major bear market lows. But I think that when we look at what the real economic reality is, it is one where earnings estimates remain too high. We have lowered the bar for 3Q earnings. We're going into earnings season expecting just 3% growth compared to 10% growth earlier in the summer. But if we look to 2023, it's still 7% growth for next year. And we heard from Fed Williams yesterday talking about a pretty significant increase in unemployment. That is not consistent with earnings growing 7%. And so I think that's the economic reality that the market needs to come to terms with, kind of post these shorter term positioning and sentiment moves.
They have said repeatedly that it is too premature to even talk about ending rate hikes. They have said repeatedly they're committed to not prematurely easing back on rate hikes. And yet here we are again after the RBA only hikes 25 and not 50. We're having this conversation. Peter Cicchini, Ray Dalio of Bridgewater, speaking of capitulation, said this about cash. When the facts change, I change my mind. What do you do, sir? Quoting, of course, Keynes, goes on to say, the facts have changed, and I've changed my mind about cash as an asset. I no longer think cash is trash. Connor Senna, Bloomberg opinion, followed up by saying this, strange to wait until a 60-40 is down 20% plus on the year to say cash is no longer trash. Would have been a good flip about 10 months ago. Cash is trash. Well, it was maybe a long time ago. It hasn't been this year, Pete. It's outperformed in a massive way. What would you say to people that still want to stay there? They want to sit in cash?
I think it does make some sense. Look, the equity market, as you know, from the beginning of the year for us was not the place to be. We expected higher rates. I think it is interesting how so many big houses have pivoted recently. One notably from 4,300 on the S&P 500 to I believe 3,600. So we've been seeing a lot of that. And, suffice to say, this is a hard job and we can all be wrong. But to pivot this late, I don't think is very helpful to investors. Fortunately, we've been positioned very, very conservatively in the expectation for, frankly, what's been going on. Staying in cash makes sense because I do think the opportunity set will continue to improve throughout the course of the year. That said, and I'm going to answer my own question again, I guess, John, sorry. Breadth in the equity market has reached capitulative lows with, I believe it's well below 15% of the NYSE trading below its 200-day moving average. And so you're going to get these vicious bear market rallies that make it feel like a bull market when it's really not. So to answer your question, we still like cash, notwithstanding some of these vicious bear market rallies that are inevitably going to occur when markets get this oversold.
It's getting better. You're answering mine and your own. Futures right now up 1.5% on the S&P and the Nasdaq 100 up by 1.9%. Just hearing from the Chancellor in the UK in an interview with GB News, a local broadcaster in the United Kingdom, saying the following. The Chancellor says the fiscal plan will be on November 23rd as planned. The fiscal statement will not be brought forward. There was some suspicion, speculation, reporting even, that maybe that budget, that fiscal statement would be brought forward ahead of the Bank of England rate decision on November 3rd. The Chancellor saying just moments ago it will not be brought forward, that it will take place on November 23rd as planned. I guess we'll see. Sterling rolling over just a little bit, not in a big way, still up 0.4%, cable 113.69. I'll pick up on that story in just a moment. Want to pick up on the Fed speak. We'll hear from Williams today, speaking right now, I think. The latest message pouring cold water on any hopes of easing off the brakes. Mike McKee has more. Mike, every single time we get a rally, we start talking about these guys backing off.
Yeah, and then we go down and then people start saying, well, they're going to have to raise rates higher because inflation is higher. You've been talking about it. If wish were father to the man, we would be at peak rates right now, at least for the markets. Investors have been looking for a sign of a pivot. They did get one today. Unfortunately for them, it's the Reserve Bank of Australia raising rates by only a 0.25 percentage point, seen as a dovish increase. Australian yields fell and U.S. and European yields also fell, continuing a mild bond rebound spurred by signs of slowing in their respective economies. The bad news, though, the difference is that Australia has lower inflation than U.S. and Europe and a heavily indebted population with variable rate mortgages that would be threatened by significantly higher rates. You mentioned it. John Williams and other Fed officials continue to make it clear they're not yet ready for a pivot here, barring a surprise collapse in consumer prices or a surprising drop in employment on Friday. The Fed still plans to raise 125 basis points by the end of the year. Williams saying yesterday tighter monetary policy has begun to cool demand and reduce inflationary pressures, but our job is not yet done. Still, as you noted, John, equities rallying along with bonds has people talking about a pivot again. Futures dropping significantly on their view how far the Fed will go after that. September 23rd futures pricing in a terminal rate of 4.7% by May of next year. Now 4.3, rate cuts starting after that. But that's still a long time away. A lot can happen. You look at the OPEC Plus meeting, everybody's talking about what effect that's going to have on oil prices and inflation. Williams emphasized that. Not just markets, not just rate cuts, but we're seeing a lot of volatility because a lot of things are going on around the world. He also noted you're still trading and the trades are working, so it's not a real problem yet.
Mike, one question I've asked is whether this rally makes it more likely, not less likely, this Fed goes big again.
I think the Fed is looking at it as markets go up, markets go down. They can't really control why they're doing that, especially with news continually breaking. So they'll look beyond it as long as people are able to trade.
Mike McKee, thank you. We're not going to talk about the RBA. The RBA getting so much attention this morning. I guess it speaks to the market move of the morning so far. Ed Yardeni of Yardeni Research was on with us in the last 24 hours. Take a listen to this.
I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. These are very restrictive monetary developments. I think they got one more rate hike coming in early November, and that'll be it because the financial stability issue will pop up as primary concern.
Cameron Dawson, that line again. I think they will have one more rate hike in November. That will be it because the financial stability issue will pop up as a primary concern. Do you agree with that?
Well, that might be the case, but that doesn't necessarily mean that it takes the pressure off of risk assets, because the reality is that it's not just the destination, it's how long you stay there in very high rates and very restrictive policy, because that's what will really slow economic activity. If we think about all of the borrowers who are exposed to floating rate debt with LIBOR rates going from 0.2% to 4.8%, this will have significant impacts on their ability to hire, do CapEx. And so, yes, they might pause to see how things happen, but the longer they stay in that restrictive territory, the more we will see it impact the real economy. And so I don't know if that would necessarily constitute the kind of dovish pivot that would want to embolden you to be very, very long into risk assets at high valuations.
Pete, what Cameron just said is so important. A pivot, a pause per se, is not necessarily bullish if you're pausing for all the wrong reasons. Pete, your thoughts on that?
Yeah, I think she just answered my question of earlier more eloquently than I answered it myself. That was precisely the point I was trying to make. I think the lag with which monetary policy acts on an economy matters, and the longer we're at these high level rates, especially when we consider where we came from, what the economy had been accustomed to and what market participants had become accustomed to, a higher for longer, even if it's not accelerating higher, makes a big difference relative to how one needs to think about risk asset allocations. That's really, I think, the key point that everyone needs to think about. There's been a paradigm shift. We have inflation now. The Fed is not going to be able to, even if it's done hiking, which I believe it is very close to at the end of the year, maybe into early next, it's simply not going to be able to cut as rapidly as it needs to unless there's something disastrous going on.
Peter Cameron, sticking with us. Futures right now up by 1.5% on the S&P. It's a nice rally. Yields lower, stocks up, dollar weaker. Up next, the UK government making a sharp U-turn.
It was becoming a distraction, so that's why we immediately changed that policy, and that's the kind of government we are. We do respond when there are concerns, and we act quickly.
The fiscal issues in Europe coming into sharper focus. That conversation up next.
I'm not talking about common debt issuance or a recovery fund or something like that, because we know that it might raise some difficulty among member states. I'm just talking about the possibility at the national level to raise debt, but with the support and the guarantee of all European member states.
A little bit of division emerging in the EU amid a call for joint debt issuance. More hawkish member states, including Germany, pushing back despite criticism over its €200 billion borrowing plan. This coming as the UK makes a bit of a U-turn on its own tax plan.
It was becoming a distraction, so that's why we immediately changed that policy. And that's the kind of government we are. We do respond when there are concerns, and we act quickly.
No more distractions. We have a plan, and we need to get on and deliver it.
I'm prepared to do what it takes to get us through these difficult times, to get us through this difficult winter.
Exhausting stuff. Team coverage starts right now with Bloomberg's Maria Tadeo in Luxembourg and Lizzie Burden in Birmingham. Lizzie, first to you. There was some speculation this morning that maybe that fiscal statement from the Chancellor gets brought forward. What did we learn recently?
Well, the Chancellor, Kwasi Kwarteng, tells us that we were merely reading the rooms. I thought he was throwing a bone to the markets here because, of course, the lack of an OBR forecast, the Office for Budget Responsibility, when the official budget came out in the beginning, undermined the credibility of it in the markets. It wasn't just Bloomberg that was reporting it, it was also the Financial Times, it was according to government sources, but Kwasi Kwarteng says, after all, we are going to have to wait till November the 23rd. That'll be after the Bank of England's meeting on November the 3rd. And so the Monetary Policy Committee isn't going to be able to take account of the fiscal watchdog's assessment of how much growth this will stimulate. Kwasi Kwarteng seems to think that we were all fools here.
It's all our fault. Nobody else's. The UK under immense criticism over the last couple of weeks. Maria Tadeo, I have to say Europe's not been spared. Germany, with their own plans and their own plans also being heavily criticised. Maria, what's the tone over there?
Listen, Jonathan, this is what 200 billion euros, when you put that on the table, can do to a continent that is facing a monumental energy crisis, but at the same time does not have the 200 billion euros that a country like Germany can spend. We know, and this is not a secret, the fiscal capacity is not even across the euro area. Now, the Germans are defending this plan. They say it is big, but so is the problem that we face. We do not want to create distortions, and this is not going to be an issue for the level playing field. But, Jonathan, I can tell you, and I spoke with the French finance minister, Bruno Le Maire, who told me we do need coordination and we need a joint response. Now, this is where it gets technical, but I know you're going to allow me to get technical. Remember the recovery fund. This was unprecedented for the European Union. It was loans and grants handled by the EU. Now, what some of these countries now say is that they can live without the grants, but they want to see something that looks like backed loans by the EU because that would give them better funding rates. So this is where the debate is at. This is not going to go anywhere, especially as the winter crisis heats up. And you're going to see more countries say, we need a joint solution. We have to find it. And the French finance minister told me this is not weeks, it's days.
You can have as much time as you like, Maria. You know that, to get as technical as you like. Maria Tadeo there and Lizzie Burden. Maria, Lizzie, to both of you, thank you. Tremendous reporting recently. Peter Cecchini, Cameron Dawson back with us. Pete, I want to go to the energy story and fold in OPEC as well. OPEC Plus teeing up a big output cut. Just how bad are things going to get on the energy front and for how long?
Well, I certainly don't think the worst is behind us. And in particular, there are two things happening into the end of the year that I think are important. The first is that seaborne sanctions for Russian oil kick in on December 5th, with the import ban kicking in early next year on February 5th. And importantly, and especially when compared to the stories on OPEC, the SPR releases end at the end of this month, and that is 1 million barrels per day that is for sale, that will likely not be coming back for sale, whatever OPEC decides to do. And so I think from that perspective, given that oil has become a substitute for natural gas in Europe, given how high natural gas prices are, oil prices will be moving higher into the end of the year, which is an important wrinkle in this idea that inflation is going to decrease and that the Fed will be able to pause. I think as energy rises, that complicates the picture for all central banks.
And potentially the economy rolls over. I think that complicates the picture for people in markets too. Cameron, it's a key question. I've asked it a number of times through the summer and into fall. Do I want to be long the energy names still going into an economic downturn?
Well, I think you do. First is because it's a great hedge in portfolios in the event that we see energy prices go up, gasoline prices go up. You could imagine that other risk assets would do rather poorly simply because those rising energy prices would lead to an increase in inflation readings and an increase in inflation expectations. Remember, gasoline prices are the biggest driver of both short-term and long-term inflation expectations when we look at that University of Michigan survey. So from a hedging perspective alone, it's valuable. But when we think about the demand and supply drivers, we're seeing that reduction in supply from OPEC. And then we're seeing the reduction in demand a possible increase in demand in China, because we have to remember that China goes into this party Congress in the next couple of weeks. They've been in lockdown with the COVID zero policy. If that starts to be released, those 65 million people that have been in lockdown that aren't traveling around, and half of China's fuel consumption goes for transportation fuels, that could introduce a uptick in demand for oil, kind of regardless of what's going on in other parts of the economy, that could put upward pressure on oil prices.
My colleague Tom Keene has said this all year. It's just amazing, remarkable. We've seen this take place in the commodity market this year, with China still maintaining COVID zero. Peter Cicchini, Cameron Dawson, to the both of you, thank you. Futures right now at 1.6% on the S&P. Coming up the morning calls, and later, Hightower's Patrick Fruzzetti from New York. This is Bloomberg. Five minutes away from the opening bell, equities up by 1.6% on the S&P 500. Equities up, yields lower, dollar weaker. That's the story this morning. That's some of the price action for you. Here are your morning calls. Let's begin. First up with JP Morgan naming Amazon its favorite internet stock, seeing a number of competitive advantages with the holiday season approaching. Citi upgrading BNY Mellon to buy, 46 price target, seeing limited credit risk and an attractive valuation. And finally, Wells Fargo downgrading Paramount to equal weight, growing increasingly concerned about the linear ecosystem across media. That is such a media line, isn't it? Paramount right now, 1962, unchanged in the pre-market. Coming up, energy stocks kicking off Q4 with their biggest rally in nearly 2 years. Hightower's Patrick Fruzzetti expecting the outperformance to continue. That conversation is coming up next. Your opening bound just around the corner with futures up 1.5% on the S&P. This is Bloomberg. 24 seconds away from the opening bound this morning. Good morning to you. Yesterday, a really nice pop on the S&P 500. We add some weight to it. Again, up 1.6% on futures. On the Nasdaq, we're up 2 full percentage points on the Nasdaq 100 on the small caps. Not exactly leaving them behind. We're up by 1.8% there as well. That's the equity story. Switch at the board and get to the bond market. Yields lower, as you might expect. We're down 3 basis points on a 10-year, off the lows of the session, but well off the highs of last week. Through 4% last Wednesday. 360.72. This Tuesday morning, we're down 3 basis points. And the FX market, dollar a whole lot weaker, euro stronger. Euro dollar 99.17, positive by 0.9%. Crude up 2.8%, up a little more than $2 to 85. And let's call it 90-something. The opening bow then, about 20 seconds in, with positive 1 full percentage point on the S&P 500. Let's get you some movers. Here's Katie.
Hey, John. Well, a lot of those gains are coming from Amazon.com, climbing after JP Morgan named it as their favorite internet stock by a wide margin. That is a direct quote. Analysts there cited Amazon's inventory advantages heading into the holidays. Amazon up 3.6%. You also have Bank of America climbing, just one of several big banks pushing higher this morning. That's even with a price target cut from Goldman and yields dropping this morning, but still Bank of America up over 2%. Moving on, we have Rivian also in the green after sticking to its goal to produce 25,000 cars this year. That means that Rivian has a market cap of $954,000 per completed SUV. For comparison, Tesla has about 425,000 in market cap per car, so make of that what you will. And finally, Poshmark, I've never used it, John, but the online fashion market, it's soaring after news that its Korean rival will buy it in a deal of about $1.2 billion. Shares up about 13.5%.
Is this when you sell your old designer clothes?
I assume so.
Is that what that is?
I mean, someone wants to buy it, so there you go.
I'll check it out. I'm sure Tom is incredibly active on there. Tom Keane, of course. Katie, thank you. On the S&P 500. 2 minutes in at 1.5% on the S&P. Every single industry group on my screen right now is positive, led by consumer discretionary up by 2.7%. Talked a lot about where we've been in the bond market. Last Monday on a 2-year 4.35, on a 10-year last Wednesday north of 4%. Where we are this morning, big turnaround from there. Yields fading off the lows of this morning, but just compare them to last week still. 4.1% almost on a 2-year, 10-year 361. All the way down from 4% last week. It's a turnaround. Yields lower, stocks up. With more, here's Kelly Lyons. Hey, Kaylee.
Hey, John. Yeah, that turnaround definitely applies to equities as well, specifically those very sensitive to rates. Just take a look at the home builders, for example. An ETF that tracks those names is higher by about 2.9% here at the opening bell, as you're seeing yields coming in once again today. You also have the financials getting a bit of a lift, and the ARK Innovation ETF, which of course houses stocks with really, really high multiples, those are getting a big lift as well, up nearly 6%. And this echoes the moves that we saw in yesterday's session. All of these groups were outperforming in the Monday rally. For the home builders, for example, they gained nearly 5% in yesterday's session. And you've got the utilities and banks and communications and software stocks all in the outperforming group as well. And of course, for software and communications, that all falls into kind of that tech basket. And I just want to spend a moment longer on those names because we know a lot of them are richly valued, more value placed on future profits, which is why higher borrowing costs have been so problematic for those names and have brought those multiples lower with prices going down. But as rates have come down, you're starting to see a little bit of catch up being played. And according to our colleague Jan Patrick Barnett and his analysis this morning, based on the latest moves we're seeing in yields, the NASDAQ 100 may have another 4% of upside. I will just end, though, with a word of caution, John, something you've noted throughout the show. We have seen a number of head fakes in the bond market over the course of the last year when it comes to that whole peak yields narrative. If we're not there yet, that doesn't necessarily mean that the tech stocks pain is over, John.
We've done it at least 4 times.
Yeah.
And at least twice in the last 3 months.
Yeah.
Kelly Lyons, thank you. Kelly, thank you very much. I think we did it shortly after Chairman Powell spoke in Jackson Hole, maybe a couple of weeks later, and then we're doing it all over again a few weeks after we heard from the Federal Reserve. Just recently, I'm exhausted, you are too, I know. On the S&P, we're positive 1.9%. On the NASDAQ, we're up by 2.4%. Stocks rebounding after shedding $10 trillion in market cap through September, setting the stage for one heated debate on Wall Street.
Where we are in terms of capitulation. The sign of capitulation.
That feel of capitulation.
We want to see capitulation.
You really haven't had that.
Getting those earnings expectations down is something that we really need to see.
Investors want to hear management speak.
See some companies rip off the earnings Band-Aid.
And really kind of throw in more of a towel.
If you're looking for panic.
Even though you've had as much volatility as you've seen.
You're not getting it yet.
The equity market probably has further to go down.
Taylor Ricks has more. Hey, Taylor.
Hey, John, and take a look at, well, at least yesterday, one trading day into the fourth quarter, and things look pretty good. That's not even counting the strength, of course, that we're seeing within a few minutes of the opening bell today. It is going to be, if you look at yesterday, the third best start ever to a fourth quarter and to October. And yesterday's 2.6% gain on the S&P, just about the 6th time that the market has added at least 2% on the first trading day of October, going all the way back since 1928. So you're getting a little bit of that bullish tone yesterday, and that continues into today. I want to be careful with the next chart, though, when we think about the Fed and rate hike expectations, because every time we think about a dovish pivot, the Federal Reserve comes out and says, no, that isn't going to happen. But at least you can see that expectations through March had been about 165 last month, and then of course today you get maybe only market expectations of an additional 125. So thinking again about a 75, a 50, and then a 25 through March, and just sort of how bullish, or well, I should say hawkish or not, this Federal Reserve is. So some of that playing into the equity markets as of late. I think when you think about capitulation, John, is it orderly or disorderly? Yes, it has been a grind lower, but it has been orderly. I've heard a lot about some liquidity issues within the bond market, but But this is a market within the equity world, as you know, it's falling, but it's not panic and it's not disorderly with massive dislocations.
Apart from the gilt market and other pockets of fixed income too. Taylor, thank you. I hear you. Taylor Riggs there on the latest. Looking forward to the close a little bit later. We're building to the gains of yesterday on the S&P, up 2%, on the Nasdaq up 2.4%. Yields are lower, though they are off their lows this morning, and the dollar index is a whole lot weaker. DXY, the dollar, down, weaker for a 5th consecutive session. Hightower's Patrick Frizzetti pointing out the risk for any further gains, saying the following: as the dollar strengthens, foreigners who need dollars or have debt in dollars sell their dollar assets, putting downward pressure on US equity markets. Patrick, I'm pleased to say, joined us right now. Patrick, let's start there. Walk us through the relationship between what's happening in foreign exchange and what we're seeing play out in risk assets in the US.
Sure. Well, you pointed to it. The dollar is weaker over the last couple of days, and the market has rallied. When it strengthened, those investors globally, or even sovereign countries that are looking for U.S. dollars, sell their U.S. dollar assets, and that puts more downward pressure on equity markets here.
Is that durable market pressure, durable downward pressure, or something that exhausts itself pretty quickly?
Well, it depends. I mean, has the dollar peaked here? I don't know. I certainly don't think rates have peaked. I would not be long duration here. I wouldn't be long duration equity, long duration equity holdings as well. So when I look at the broader market, I see, the dollar weakening temporarily, and quite frankly, we're positioned, in the energy space and the commodity space for the coming months.
Patrick, I'll pick up on the commodity story in just a moment. With regards to the bond market, that judgment call you just made, what are the assumptions that underpin that?
On the rate market?
Yeah, that we haven't seen peak yields.
Yeah, so when I look at broader commodities, again, right now we're in a supply-constrained market. So I continue to see, we heard OPEC, they're going to be speaking tomorrow. They're going to look to cut roughly 1 million barrels per day. So that's going to continue to support energy. When we look at gold, again, just look at the dollar being down roughly 15% through today. Gold is down roughly 6%. On the year, I actually think gold has held up pretty well. If you look at gold in yen terms, if you look at gold in euro terms, it's held up well. It's done its job. It's really provided a hedge against the risk of fiat currency debasement. So we still continue to like gold exposure here.
Patrick, I wanted to talk to you about cyclical exposure as well.
Yeah.
Still like energy. You like the rails. I understand from the rails perspective, there's more of a long-term story underpinning that. But talk to me about how you want to add cyclicality at the moment.
Yeah, so the rail space is sort of a good example of the fact that right now we're in a time where we're deglobalizing, right? So when we think of structural inflation, we look at deglobalization, we look at sort of demographics and the labor market, right? So who's going to benefit? So just look to a country like Mexico. They can still produce cheaply. So owning a Class 1 rail, like, say, for example, Canadian Pacific, they have rail lines all the way from Mexico up to Canada now after, their acquisition of Kansas City Southern. So we like that space. There's been a lot of consolidation in that space over the last decade. They're getting pricing power. It's an onshoring play, and they can move a lot more material, cargo, et cetera, using a lot while burning a lot less carbon. So I think it has a lot of structural advantages over the next 10 years.
And Patrick, what would you say back to people who say, why would I want to buy it here? I get the long-term story, I get all of that, but why would I want to buy it here before we've seen the economic downturn really gain momentum?
Yeah, because quite honestly, I don't think they're as, I think they're actually a little more defensive than people think. We're going to continue to move product, across different sectors. And again, when you have this onshoring play, that's a bullish tailwind. And then, you fold that into, compare that, dovetail that with where valuations are today. I think it's a very attractive situation.
We'll return to that call before the end of the year, no doubt. Patrick, thank you. Patrick Frizzetti there on the rails there, and where he's optimistic, more constructive on this equity market. Up next on this programme, Meta dialing back growth plans in New York City as corporate America turns to hiring freezes.
The hiring freezes and the trading down to a lower level are appropriate. I think there's probably some concern in Q1 of next year. So I think we're kind of showing that things are slowing down. Order books are still not too bad, but clearly Q1 is a concern.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up on Balance of Power, Sanjay Mehrotra, Micron president and CEO. That's at 12:50 p.m. in New York, 5:50 p.m. in London. This is Bloomberg.
The hiring freezes and the attriting down to a lower level are appropriate. I think there's probably some concern in Q1 of next year. Nobody ever wants to lay people off in the Thanksgiving, Christmas holiday period, and you really can't do a layoff till late January. So I think we're kind of showing that things are slowing down. Order books are still not too bad, but clearly Q1 is a concern.
Softer manufacturing data, softer than expected yesterday. The weakness starting to creep in. We're seeing it in corporate America as well. Meta closing one of its New York offices with more cutbacks looming. A spokesperson saying the following: "We are working to ensure we're making focused, balanced investments to support our most strategic long-term priorities." Taylor, that corporate speak drives me nuts. What's the latest?
I know, and I hear you, John, and I think the comments from Zuckerberg last week were really interesting, saying that he's looking at a company in 2023 that actually might be smaller than it is today. And you see that maybe coming from the pressure on top-line growth, as you have a company that's looking at what could be a 4%, maybe a 1% decline year over year in this quarter, and then that drops as much as maybe 5% on a year over year drop in sales and revenue next quarter. That might be peak, as then the company rebounds a little bit, but then still looking in the fourth quarter at what could be still a decline on top line growth year over year of about 3%. So all of those headwinds then lead into a company that's looking at maybe job openings that are easing, with the companies saying not layoffs, but maybe hiring freezes, and indeed pulling back on some of the New York City offices that I know that we had a great story out this morning talking about that, and just sort of rethinking, as you mentioned, some of those long-term priorities and balancing the investment versus the growth.
Taylor, thank you. I think the phrase Taylor used then is really important. Hiring freeze is not layoffs, and a line we've talked about repeatedly over the last couple of weeks is that you can't fire what you could not hire. So we're going to see this show up in jobless claims or show up in JOLTS, job openings. Job openings coming out a little bit later, and arguably that's what the Fed is shooting for, to get job openings lower without really taking a big chunk out of the labour market. Mary Daly speaking right now of the San Francisco Fed and saying the following: inflation has not gotten into the psychology of Americans. I guess that's the good news for them. Sees a lot of room to slow the labour market. That's what she's speaking to. Looking abroad as well, not just domestically, saying the following: the Fed is aware its moves affect the global economy. The global economy is having a tougher and tougher time of it. Can you imagine trying to put together a strategic reorg in a world like this one? Credit Suisse rebounding this morning from a record low. The spotlight on the company's restructuring plans amid concerns over financial health. On top of this story for us has been Bloomberg's Sonali Basak. Morning, Sonali.
Good morning, John. You're looking at Credit Suisse ADRs yesterday closing above where they closed Friday, and you're watching the shares also close higher in Switzerland. So yesterday was a bit of a blip in the radar, but that does not ease many concerns still on the horizon. There's a lot of calls here from Wall Street sell side on whether they should be moving up their strategy review, the announcement that they're supposed to be making at the end of October, because the stock is trading something close to a meme stock until then. If you take a look online, it's kind of incredible. You're watching crypto traders looking to buy Credit Suisse at its low. But at the same time, there's a lot of struggles ahead, and Bloomberg's Allison Williams pointed it out very craftfully, which is that until you have a sense of what a potential capital raise could look like, it's very difficult to figure out what that stock is worth today, because it's such an event could be quite dilutive. Listen, Credit Suisse is really trying to pull a Deutsche Bank here, potentially sell some assets, get rid of some businesses to help fill that gap in that capital raise. But let's play investment banker here for just a second, because it's not where Deutsche Bank was just a couple of years ago, where the market was still soaring high. Selling assets at these levels will be lower than whether if they started to sell just a year ago. They also have to drum up demand. And right now, a lot of firms are very reticent to take on risky assets. So the types of deal making Credit Suisse could make in this environment could have to get very creative here to start filling that what analysts think is a $4 billion hole that they'll need to fund this restructuring.
Sonali, I think you framed it perfectly. Just nailed it. this is going to be difficult to achieve. What's frustrated me when it comes to the likes of Credit Suisse, the likes of Deutsche Bank, and I wonder if it frustrates you, that we keep benchmarking to Lehman, that it's either Lehman or it's okay. And there is something in between here, Shonali, and it's still not great.
If for no other reason than that these firms have become semi-utilities since then, right? They have the full faith of the governments behind them. But beyond that, John, you have this firm trading at less than a fourth of its book value. Take a look across the European banking sector. Most of these firms are burning money and are also trading below their book value pretty steeply. And I think that's a pretty remarkable event to face.
Shonali, thank you. Looking forward to your coverage, as I've said repeatedly, through the next several weeks on this, into the end of the month when we expect to hear that strategic reorg, that big plan from Credit Suisse, and then in a few weeks' time you'll hear from JP Morgan and we'll kick off earnings season as well. Equities right now up 2.4% on the S&P 500. Yields were much lower. I have to say that story's faded. The 10-year basically unchanged at 363. The 2-year, big move lower yesterday by about 17 basis points off the back of the ISM manufacturing number that came in a bit softer. A lot more going on than just that. 4.1% on a 2-year this morning. We're down about 2 basis points. I want to get you some sector price action, lift the lid on the equity market with more. Here's Kaylee.
Well, John, literally everything is in the green. That is true on a sector level and on an individual mover basis. There's only right now 3 stocks in the S&P 500 that are not in positive territory on the day. So no surprise when you look at the IMAP function on the Bloomberg, everything is gaining to the tune of 1.5% or more. And of course, you see at the top there some of those rate sensitive sectors still outperforming, even though we have seen things turn around in the bond market. The likes of financials up about 3%. Consumer discretionary also higher by more than 3%. Of course, big weightings in that index include Amazon and Tesla, some big tech names that are seeing some big gains today. When you take a look even further beneath the surface at some of the more isolated sectors as well, consumer finance, this of course has a rate sensitivity factor when it comes to mortgages. If mortgage rates aren't extraordinarily high, you may have more people looking to take out loans and buy a home. So that's feeding through to names like Zillow, higher by about 4% with about 20 minutes into the trading day. And then you also have some internet retailers higher as well. Part of this is idiosyncratic, the story with Poshmark being bought by a Korean rival for $1.2 billion. But part of it as well is just the broader risk rally we are seeing, the idea that if borrowing costs aren't as high, people may have more money to spend. So you're seeing Wayfair up about 7.4% as well. But again, John, now looking at the moves in the S&P 500, just one stock is in negative territory on the day, and that would be Dollar General.
There we go. I think that speaks volumes at the moment we're in. At the moment, at least. Let's see how long it lasts. Katie, thank you. This from Mary Daly, the San Francisco Fed president. A narrow path to a soft landing, but it's not closed. Every time we get a rally, we end up having the same conversation. A Fed pivot. The S&P 500 up 2.4%, the Nasdaq up 2.8%. And to be fair, if you compare where we're priced on a terminal rate now compared to last week, we've come in about 30 basis points. That's material. That speaks to the readjustment in the equity market. Whether the Fed's going to pivot or not is a separate debate, and whether the Fed is pivoting for bullish reasons is a very different conversation as well. Up next, the trading diary from New York. This is Bloomberg.
The reality is, though, that interest rates are set by the Independent Bank of England. They make those decisions on the basis of what's happening with inflation and other factors. The energy intervention that we have done is likely to curb inflation by up to 5 points, so that has a positive effect. But ultimately, what we're seeing around the world in the wake of Putin's war in Ukraine is interest rates rise. So the Federal Reserve, for example, has pushed up interest rates. So we will do, what we can to support people, but ultimately it is a decision for the Independent Bank of England.
Of course, the first mission of the new management of EDF, Luc Rémont will be at the head of EDF, is to have those 12 nuclear plants being reopened as soon as possible. I mean, by the beginning of 2023, we want all these 12 nuclear plants being reopened, because there is a need for nuclear plants and there is a need for nuclear electricity.
It's a difficult time in Europe, and it might not be just for one winter. It could continue for a number of years, speaking to a number of energy experts. Equities right now up 2.3%. The gains continue on the S&P, on the Nasdaq 100 up by 2.6. The gains continue even as the move in the bond market fades. 2s, 10s and 30s yields were so much lower. Now basically unchanged on a 10-year, 363.49. Your 2-year, 4.1%. With that in mind, we'll see if these equities gains stick, if that bond market carries on moving in this direction. That's the price action. Here's your trading diary. First up, durable goods and jolts. Coming up the top of the hour, President Biden delivering remarks at 3 p.m. Eastern. Busy stretch of Fed speak continuing with daily again this afternoon, followed by Bostic on Wednesday, plus OPEC meeting in Vienna. And finally, the US payrolls report is coming up on Friday. I can tell you the estimate right now on payrolls, 265 in our survey, down from about 315. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.